The financial world is watching something unprecedented unfold in the silver market. JP Morgan, one of the biggest banks in America, finds itself in a dangerous position. The story involves billions of dollars, tons of physical silver, in a situation that could shake the entire precious metals industry. For years, JP Morgan dominated the silver market. They controlled prices through paper contracts. These contracts are promises to deliver silver in the future. But here's the problem. Many of these contracts were never meant to be fulfilled with real metal. The system worked on the assumption that most people would settle for cash instead of physical silver. That assumption just collapsed. On December 3rd, 2024, something extraordinary happened. Someone demanded delivery of 5.2 million ounces of physical silver from COMEX. COMEX is the main marketplace where silver futures trade in America. This single request shook JP Morgan's metals desk to its core. Why? Because the vaults did not have enough registered silver to meet this demand easily. Let's understand what this means in simple terms. Imagine you write 100 checks. You assume only 10 people will actually cash them. Your bank account only has money for those 10 checks. Then suddenly, 50 people show up to cash their checks on the same day. That is exactly what is happening to JP Morgan in the silver market. The bank sold massive amounts of short positions over the years. A short position is a bet that prices will fall. When you short silver, you sell contracts promising to deliver the metal later. JP Morgan made enormous profits doing this. They would dump huge sell orders onto the market. Prices would crash. They would buy back the contracts at lower prices, then pocket the difference. This strategy worked perfectly for years. The bank paid $920 million in fines back in 2020 for manipulating precious metals markets. They admitted wrongdoing. Several of their traders went to prison. But the trading continued. The profits were simply too large to ignore. The system depended on one crucial factor. Most contract holders would accept cash settlement instead of physical metal. Industry insiders estimate that for every ounce of physical silver, there are over 100 ounces of paper claims. This works fine in normal times, but these are not normal times. The physical silver market is experiencing an unprecedented shortage. Global industrial demand hit record levels in 2024. Solar panel manufacturers need massive amounts of silver. Electric vehicle producers require it for electronics. Semiconductor companies cannot function without it. The green energy revolution consumes silver at an accelerating rate. Meanwhile, mining production barely increased. New silver mines take years to develop. Existing mines face declining ore grades. Environmental regulations limit expansion. The supply simply cannot keep up with demand. Experts predict that demand exceeded supply by 176 million ounces in 2024 alone. Over the past 4 years, the cumulative deficit reached 678 million ounces. That equals 10 months of global mining production. This is not a small gap. This is a structural crisis. Now add another explosive element. Investors worldwide suddenly want physical silver, not paper contracts, not promises, real metal they can hold. This shift changed everything. COMEX vaults began draining at an alarming rate. Between October 3rd and November 15th, 2024, a staggering 37.6 million ounces vanished. That represented 47% of registered silver disappearing in just 47 days. Registered silver is metal that can be delivered against futures contracts. When it disappears, the exchange struggles to fulfill its obligations. The crisis accelerated in early December 2025. In just 4 trading days, buyers claimed over 47.6 million ounces for delivery. That is more than 60% of available registered inventory, gone in 4 days. The vaults were being systematically drained. JP Morgan found itself trapped. The bank held enormous short positions. These positions were now underwater. Silver prices surged past $60 per ounce. Then they hit $65, all-time record highs. Every dollar increase in price cost JP Morgan millions in paper losses. But the real danger was not the price. The real danger was delivery demands. When someone holding a futures contract demands physical delivery, the seller must provide actual metal, not cash, not a promise. Real silver bars sitting in a vault. JP Morgan's options were all bad. They could try to buy physical silver on the open market, but there was not enough available. Premiums were exploding. Dealers were running out of inventory. Some stopped taking orders entirely. The physical market had seized up. They could try to convince contract holders to accept cash settlement, But why would anyone do that? Silver prices were rocketing higher. Anyone holding a contract for physical delivery at lower prices had struck gold, or rather silver. The bank could admit they could not deliver. This would be catastrophic. It would expose the entire paper-silver system as a fraud. Trust would evaporate instantly. Lawsuits would follow. Regulatory investigations would intensify. The reputational damage would be incalculable. Or they could raid their own physical stockpile. JP Morgan had been quietly accumulating physical silver for years. Some estimates suggest they hold over 750 million ounces, the largest private stockpile in the world. But using this silver to cover short positions meant admitting their trading strategy failed. It meant bleeding their strategic reserve. The situation exposed a fundamental flaw in the modern commodities market. The pricing mechanism depends on paper contracts, but these contracts trade at leverage ratios that make cryptocurrency look conservative. When enough people demand physical settlement, the entire structure becomes unstable. History provides a chilling parallel. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions. Prices soared to $50 per ounce. Then, the exchange changed the rules. They restricted trading. The Hunt brothers could not meet margin calls. The position collapsed. They lost billions. The event became known as Silver Thursday. But this situation is different. The Hunt brothers were speculators trying to manipulate prices upward. The current crisis stems from genuine physical shortages meeting years of price suppression. Industrial users need the metal. Investors want the metal. Sovereign nations are accumulating the metal. This is not manipulation. This is supply and demand finally asserting themselves. The December 2024 delivery request sent shockwaves through the industry. Sources inside the metals trading community reported frantic phone calls, emergency meetings with regulators, desperate attempts to source physical metal from anywhere possible. Some smaller banks quietly failed to deliver. They paid premiums to exit positions. The failures were kept quiet to avoid panic. JP Morgan withdrew hundreds of thousands of ounces from the eligible category. Eligible silver sits in COMEX vaults, but is not available for delivery against contracts. Moving it to eligible status is a defensive move. It signals the owner does not want that metal touched. The timing could not be worse for the bank. Silver options for the December 2024 contract expired on November 25th. This is when holders decide whether to exercise their right to buy physical metal. The volume of exercises overwhelmed the system. Delivery demands poured in. The queue grew longer. London faced similar problems. The London Bullion Market Association handles most global silver trading. Their vaults showed that day will change everything. JP Morgan's past makes this crisis especially significant. The bank has a long history with precious metals, some of it glorious, some of it dark. JP Morgan himself was a legendary financier who helped stabilize the American economy during panics. But the modern bank bearing his name has faced repeated scandals. The 2020 settlement was not their first brush with metals market manipulation. Traders used a technique called spoofing. They would place large orders to buy or sell. These orders moved prices. Then they would cancel the orders before execution. It created false signals about supply and demand. Other traders made decisions based on these false signals. JP Morgan's traders profited from the confusion. 3 former JP Morgan traders received prison sentences. Michael Nowak, the head of the precious metals desk, got 1 year. Greg Smith got 2 years. Other traders cooperated with authorities and received lighter sentences. The bank paid the massive fine and promised reforms. But the underlying strategy apparently continued. Now that strategy may have reached its breaking point. The bank reportedly closed its entire 200 million ounce short position recently. They flipped to being long. Long means betting prices will rise. This represents a complete reversal. If true, it suggests JP Morgan sees what is coming. They are getting on the right side of the trade. But closing such massive positions has costs. Buying back shorts when prices are rising means taking losses. Huge losses. The exact figures remain unknown. Banks do not publicly disclose their precious metals trading profits and losses in detail, but analysts estimate the damage could reach billions of dollars. The broader implications are staggering. Silver is not just an investment metal. It is critical for modern technology. Solar panels need it. Electronics need it. Medical equipment needs it. If the pricing mechanism breaks down, entire supply chains are at risk. Manufacturers cannot plan. They cannot budget. Uncertainty paralyzes decision-making. Some observers predict this could force a complete restructuring of commodity markets. Exchanges might impose strict limits on leverage. They might require much higher percentages of physical backing for paper contracts. Some suggest moving to fully allocated systems where every contract matches a specific bar of metal. These changes would reduce speculation, but they would also reduce liquidity. Markets would be less efficient. Prices might be more volatile. The really frightening scenario involves contagion. Silver is not the only market operating on high leverage and fractional reserves. Gold has similar dynamics. Other commodities too. If the silver market breaks, investors will question all commodity markets. They will demand physical delivery everywhere. The entire structure could come unstable. Central banks watch nervously. They remember 2008 when faith in financial institutions collapsed. They remember the overnight lending market freezing. They remember banks refusing to trust each other. A commodity market failure could trigger similar dynamics. Credit markets could seize. Banks could hoard liquidity. The damage could spread far beyond precious metals. Some see opportunity in this crisis. Investors who bought physical silver years ago are sitting on enormous gains. Silver has risen from around $18 per ounce in early 2024 to over $65 currently. That is a gain of more than 250%. Those who took delivery and stored metal safely are now being proven right. And the phrase, "if you do not hold it, you do not own it," has become a rallying cry. It means paper claims are not the same as physical possession. In normal times, this distinction seems paranoid. In times of crisis, it becomes wisdom. What happens next? Several scenarios are possible. The most optimistic involves JP Morgan successfully navigating the delivery demands. They tap their physical reserves. They source metal internationally. They pay premiums to acquire what they need. Contracts get fulfilled. The crisis passes. Prices eventually stabilize at a new higher level. The market adjusts to the new reality of genuine physical scarcity. A middle scenario involves some defaults but contained damage. Smaller players fail to deliver. They settle in cash at massive premiums. Some lawsuits follow. Regulations tighten. But the major institutions survive. Trust is damaged but not destroyed. The market continues functioning, though with reforms. The pessimistic scenario is darker. Major defaults occur. JP Morgan or another large institution cannot meet delivery obligations. Panic spreads. Investors flee paper markets entirely. Prices disconnect completely from fundamentals. Regulatory bodies step in with emergency measures. Trading halts. Force majeure is declared. Contracts are settled by government decree rather than market mechanisms. Faith in commodity markets suffers lasting damage. Which scenario unfolds may depend on decisions made in the coming weeks. How much physical metal can be sourced? Will Asian sellers ship metal west? Will governments intervene? Will exchanges change rules to protect short sellers? Each choice carries consequences. One thing is certain. The days of easy manipulation are over. The physical market is asserting itself. Reality is catching up to paper promises. JP Morgan's gamble on unlimited paper silver met the immovable object of limited physical supply. The bank is now fighting to survive its own strategy. Whether they succeed will depend on how deep the physical shortage runs and how many others demand delivery. Every day brings new developments. Every day the pressure builds. This is not just a story about one bank or one commodity. This is a story about the nature of modern markets, about the tension between paper and physical, about what happens when leverage meets scarcity, about the moment faith in a system finally breaks. The coming days and weeks will determine whether JP Morgan's gamble ends in painful adaptation or catastrophic failure. Either way, the silver market will never be the same. The illusion of infinite supply has been shattered. The truth is emerging, and truth, as they say, shines like silver.